And this one is outperforming today. Look at that relative strength line. Very nice.
Right, but it's barely trading. It's only got 21,000 shares right now, so very, very light volume. But what I do like about it is um, the it's made this long cup with handle, and the handle is just really the volume has dropped off for the last week or so, and it's trading very tight. And so and actually biotechs there's a lot of biotechs that are setting up. I mean, argenx was one, but then the news hit
Right.
today, so that's always an issue. So in some ways, with now at least this is a profitable biotech, and has good sales growth as well. So you can go ahead and buy it outright. I think with some of the more developmental stage biotechs, a buying a call is better, because then your risk is you know exactly how much you can lose. And if a competitor or a bad test comes out, then you only lose what the option cost you. But all that said, this is the kind of setup, especially in a stronger market, that I would really be ready to jump on if it started moving with some volume.
Chris, you took me by surprise, and a very positive surprise, because I think the idea of using options for these very, very volatile biotech stocks make a lot of sense. So given what we've been writing about in the options column, using a simple long-term call position as a synthetic long, doing a bull put spread, doing a bull call spread, it seems like those could be some really good ways to trade not just NBIX, but a lot of these.
Oh yeah, absolutely. Now with NBIX, I would feel fine buying the shares, just because they've got earnings and sales going on. But what's also nice about that is, if let's say you do get a development stage biotech that really takes off, and you're using options, you can roll those options, so you can sell the option that you got, and then sell it for a profit, and then buy an option that is now closer to the price with more time, and you're basically locking in a good chunk of your profit, but you still have the same amount of exposure. So it's a great way to take profits on the way up without giving anything away.
Is there an example of a stock that worked like that?
Oh, I've looked at some over the years, and if you remember Chris McCon, he and I went over it. Sure. as a it's a good way, especially for folks who have trouble taking profits into strength, rolling options over to another strike 3 months out that's near the price. You can essentially keep the same amount of exposure and lock in profit.
I think for the benefit of our audience, because we have 1,500, 1,600 people tuning in live. Some are real experts at options. Some have never heard. What do you mean, Chris, by rolling? Could you simply explain what rolling
well, just meaning that you
is?
take your position, and you sell the position, the current position, and then you buy another similar position, but at a month that's ideally 3 or 4 months out, so you're not faced with any the time loss is not an issue. And
right.
And because you're, again, buying near the money, the option is going to cost less than the one that you just sold that has a lot of profit in it.
Okay. And this this rolling of options, is something that can be done so often with just a couple keystrokes with certain.
Oh, sure.
Yeah.
And then the
platforms.
only time where it stops working is when the implied volatility rises so much that the options are no longer cheaper, or it's not as good of a deal as it once was. So,
Mm.
but often, I mean, you can go back and look at stocks that we're breaking out of first stage bases and see. And what's nice on Thinkorswim, you can go back in time and take a look at what the options were at that time and say, okay, yeah, there was this is the price of the option then, and this is what it could have been replaced with.